Hey, this is Matt from InvestiQuant. Today is Thursday, September 10th, 2020. Yesterday we saw a big day in the markets. We got a gap and go that took off to the upside after some of the selling that we've seen for the past week or so. So we ended up moving higher and giving us the largest rally on a close-to-close basis that we have seen in a few weeks. So I want to look at that pattern, see what it has led to the following session. So let's take a look. We'll look at all four instruments this morning. The setup is going to be getting long at the open, which is 9:30 a.m. Eastern time. The exit will be 4:15 p.m. Eastern time, which is the end of regular trading hours. So looking at the full session here for what has happened historically. For opening filters, we are currently trading down in the overnight session following that rally yesterday. And we're trading down, but within the prior day's range. So I'm going to use a gap down within the prior day range. So those are two separate filters, one for gap direction and then one for opening areas. So you can gap up or down in the prior day range. We are trading lower than the prior day close. So that would mean currently we are looking like we'll gap down in the prior day range. Now I'm going to go into this price patterns section, and I'm going to find the unique move for day after largest rally in 10 days. And that's available over here in the unique move section. And it's the very top option. So I'm going to hit equals right here, day after largest rally in 10 days. And this is defining a rally as a close to close move here. So I've got that selected. And lastly, what really makes this interesting is we're getting this large rally relative to the past 10 days, but it's still taking place below a 10-day simple moving average. But we are above the 200-day moving average. So again, like a weak bull market, under a 10, above a 200, but we're getting a large rally. So let's take a look at this by clicking View Results here. And here we go. So these are the results of going long at 9:30 a.m. Eastern time, exiting at the close 4:15 p.m. Eastern time when you open lower but within the prior day range, following the largest rally of the past 10 days, below a 10-day moving average and above a 200-day moving average. It looks like we've got around 30 samples in all of the instruments. The S&P is coming in at 29 samples, the NASDAQ 31 samples, the Dow 33 samples, and the Russell 42 samples. And looking at the win rates on these, all of them, with the exception of the Russell, which is 50-50, are coming in weak. So 34% for the S&P, 42% for the NASDAQ, 33% for the Dow, and 50% for the Russell. So 3 out of 4 of these have had some pretty weak days historically when it comes to finishing with a green or a red candlestick. So the majority of these have finished with a red candlestick is what this weak win rate means. And let's take a look at average win, average loss. You can see definitely some skewing going on. The average win on these is smaller in all 4 instruments than the average loss. So let's take a look at this results distribution. I've got the S&P selected here, so we'll be looking at the results for the S&P. So this graph is a histogram of the results within this test. And the way it's set up is you've got the trade count on the vertical axis. So the taller the bars, the more trade counts you have. And on the horizontal axis, you've got the amount, and these are in dollars based upon trading a single contract. Right here in the middle is 0. Anything to the left, which are the red bars, these are losing days, and the farther they go to the left, the bigger the losses. On the right of the 0 line, we've got the positive days, and the farther to the right, the bigger the gains for that day. So a quick glance at this, and you can easily see there has not been a lot of outsized winners with this pattern. There's only a couple of them sitting over here on the far right. Most of the winners are small. However, on the loss size, you've got quite a few of the larger or taller bars here for large losses, and you've got them kind of spread out throughout this histogram. So definitely skewing to the loss size, and when you look at this just at a glance, you see a little grouping here of the small wins and then a couple outliers, whereas the losses have larger bars for some of the bigger losses as well as the smaller losses. So historically, this really stands out that big winning days after this pattern have not happened very often. So hopefully you found that helpful. Good luck today, and we will see you next time.